Hello members and welcome to the Fat Profits Macro webinar. Thanks for your company today. My name is Roger Malik, the host for today's webinar. Joining us today is firstly our founder and CEO, Angus Geddes. Angus, welcome back after a break. Hope you're all refreshed and ready to go.
Yeah, no, very refreshed, Rog. Always good to be back on the webinar.
Great, lots to talk about today. And also, as a bit of a change, we also have Simon Wheatley, our property and REITs manager. He'll be joining us shortly, and we'll have a section towards the end of today's webinar to discuss the property sector and answer some questions you may have. So Simon always has some good insights on that as well. So he'll be joining us shortly. So before we get into the presentation, usual housekeeping, all our presentations are general in nature. We don't provide any personal advice. If you're looking for that, please see your financial planner or advisor, and also past performance is no indicator of future performance. Now, as always, if you're new to the service, you may ask a question apiece about the macro events. This webinar is all about the macro, the big picture, what's moving the markets, and provide a bit of market direction. If you're looking for stock related questions, we have a webinar on Monday with the research team, and that might be more suitable for stock specific questions. So let's get into the webinar now. First thing first, quick look at the topics we're going to cover today. We'll look at the Australian inflation, which has come out yesterday. We'll look at banking jitters coming back in the US, the reporting season in the US as well, the market breadth, which is quite interesting. We'll cover oil, euro and USD today, leading economic indicators to see what they're pointing at, gold price, and we'll also cover the indices, including ASX 200, Russell 2000 and the S&P 500. And of course, as we discussed earlier, we will have a good piece today on the property sector and the real estate investment trust. Let's get started with the market update. Over the last week, from Thursday till today, we've seen pretty much red across board, and really the banking jitters coming back. That's one of the factors. Of course, looking at the earnings season as well, we'll dive into that shortly. But the ASX down about 1% at the moment from last week. If we start with Australia first, Angus, Australian inflation figures came out yesterday, and the quarterly numbers are now sitting at bang on 7%. And now a lot of conversation is around the Reserve Bank as to what they're going to do. You know, if you really take a deep dive into the inflation figures, we can see from last year closer to the 3% mark, and you know, probably around 7.8%, now down to 7%. What are your thoughts on inflation? Is this kind of expected, or is this a little bit higher than expected?
Well, it was certainly a little bit higher than expected. You know, the market was looking for about 6.9, and so it did come in a touch above general expectations. Look, the good news was that it's trending down, but it's still a big number. It's still a really big number, and I think there's going to be a lot of debate at the RBA over monetary policy and whether, you know, whether current rate settings are going to be enough to do the job in terms of bringing the inflation rate down. I mean, you know, just prima facie looking at it, you know, if you've got the United States with inflation sort of running at 6.5 and a Fed funds cash rate sitting at sort of around 5, and then, you know, we're sort of significantly below that level, and we've still got, you know, higher inflation. I'm sure the debate at the RBA is now going to shift towards whether more rate hikes are going to be needed. Now, the RBA does sit down to debate monetary policy next week and set rates, and you know, whilst they may continue to hold the pause on Tuesday, I think there'll be a lot of discussion about whether they need to go again.
Absolutely. Yeah, the expectation, you're right, Angus, the expectation seems to be for now that they'll probably hold, but if the data continues to point to more hikes, they may have to do it, but time will tell, I guess. But for now, at least the inflation looks like it's peaked. There's a lot of water to go under that bridge before we can start to get comfortable with the high level of inflation. Well, let's move on to the big news, which is really moving the markets in the last 2 days, is the banking jitters sort of coming back again. The First Republic is really the one in the limelight. And, you know, they reported their earnings. They reported over $100 billion of outflows, which was larger than expected. And they're now looking to sell some of their assets at a loss to cover for some of these losses. How do you see the banking jitters coming back? First Republic is down from $220 down to $5, so over 95% losses. What are your thoughts on the whole topic?
Well, I think, you know, for the regional banks in America, where you've got sophisticated money market instruments over there, you know, allowing investors to take money out of their bank and put it into a money market fund, getting a risk-free rate of return of sort of 5%, 5+%. You know, it's hard to see how some of these regional smaller banks, which are really dependent on deposits and paying deposits at sort of lower rates than you know what the Fed funds rate is at the moment. It's hard to see how this is all going to reverse anytime soon. Now, you know, this is not really a credit problem per se in terms of what we saw in 2008. You know, with the credit bubble bursting, and of course, you know, a lot of that credit were low quality loans written over inflated real estate, which eroded quite quickly in terms of price, giving the banking system a nasty shock. This is the other side of it, where, you know, the banks have lent money out and they're funding it with a short-term deposit base, so they're getting squeezed. And no matter which way you look at it, I think this is not good for the banks, certainly in America, where you've got a double whammy of your net interest margins are being squeezed because you're being forced to pay higher rates to attract and secure deposits. And then on the other side of it, you know, some of these banks are going to be very reluctant lending money out again anyway. And you're almost going to, you know, I think we're heading into a credit crunch. So yeah, I think it's a problem. I don't think it's comparable to what we saw in 2008, which came from the asset side of the balance sheet being incurring write-downs. This is more about deposits and funding, but it does, you know, sort of say to me that, you know, credit conditions are going to tighten significantly, and of course, you know, that could certainly result in a recession being brought on by the end of the year.
Okay, quite interesting. And yeah, looking at the Fed's balance sheets here, they've been tightening over the last 12 months, and yeah, recently you can see the big bump that they had to fork out quite a few $1 billion to help out some of the other banks, but now they're back on the tightening trail. So that's the main goal for them. Let's move our focus now to the earnings season in the US. We know that the Q1 earnings are currently being reported, and this is really a super busy week where a lot of the big companies are reporting along with the others. And as we know from previous conversation, 87% of the companies in the S&P 500 will report the earnings by 5th of May, so it's quite action-packed. But we know that some of the big names which have reported are not too bad, Angus. If you look at, say, Microsoft, for example, over the last 24 hours, they've reported good numbers. Alphabet was good numbers, but the market sort of had it flat. You've got Meta, which has just reported after market close yesterday. They reported better numbers than forecast. So I guess the question comes back to, how do you see the early signs in this reporting season? Is it a case of lower benchmarks and then companies beating those benchmarks and looking good? Or is it an underlying case of you're looking at year on year, still a bit of a decline?
Yeah, look, I think it's been a very patchy reporting season, Roger. You know, you've got a few companies, a handful coming out with strong beats, and as you said, you know, we had a good, very strong beat from Microsoft, where the market reacted favourably. We had a profit beat from Alphabet, but the market didn't buy it and didn't react to that result at all, really. So it has been patchy. For every company that's coming out with a big sort of headline beat, there's a lot of companies that are missing and not doing well. And I think all in all, the message that we've sort of been sending to investors that, you know, the earnings are just not going to be there. It's just not going to be there on the growth side, really, to justify this rally. I think that story is really beginning to come through, you know, and that's why we've seen the underperformance and the Russell 2000 small mid-cap index, which is sort of trading near its October lows. We've seen similar things happening in a similar pattern in some, in the Dow Jones, which has got more sort of cyclical old bricks and mortar companies that make up that index, and of course the Dow Jones Transport. So yeah, I think it's been patchy, and if anything, it does point to Wall Street's very well traversed path of lowering guidance into the reporting quarter, and then coming in with a beat and it being better than feared. I think we saw that dynamic play out in spades during the December quarter and in the September quarter last year. But the pattern doesn't seem to be repeating. We seem to be having more companies that are missing and disappointing the market this time around than surprising and on the upside.
Okay, well, there's still plenty of more companies to report, but this chart, and I think you put up in the daily fat chat, is also very interesting, because the S&P 500 historically, when it rises in a meaningful way, most of the companies rise together and the whole index. But at the moment, we're seeing quite the opposite, whereas the breadth of the S&P 500 is at the lowest level since 2005. So what does that actually mean, Angus? Just so members can really understand this clearly, what does this actually represent?
It means that essentially most companies that make up the S&P 500 are actually not doing that well. In other words, the headline rally in the index up to 4,200, and albeit it was the S&P 500 was sort of trading well below 4,100 last night. But the rally is being led by just a handful of names. In other words, the breadth is just not there. It's just not there. We're just seeing a few companies lead the market higher, and that sort of indicates to me that all is not well below the surface, and that the market internals are actually looking quite dicey. And hence our cautious defensive approach, albeit it's taken some time for it to sort of play out. Typically in a new bull market, you get breadth, really wide breadth across the spectrum. You get small caps, mid caps, cyclical stocks, everything sort of breaking out on the upside. So if this bull market is to be believed, and granted, I have to concede the technical setup of the S&P 500 on the surface does look bullish. If this if a bull market is to be believed and the bull case is to be proved, we will need to see the S&P 500 not only climb above that 4150 level, but it will have to be accompanied by breadth in terms of the rally broadening to different sectors within the market, because those handful of stocks such as Microsoft, I mean, you look at their valuations today, I mean, you're paying up for the growth. Microsoft on a 34, 35 times multiple, Alphabet on a 24 times multiple. I mean, these stocks are not cheap. Some would argue that they're priced to perfection. And they're also, I think, masking a problem beneath the surface, where a lot of companies actually probably make up the bulk of the index are actually not doing that well at all.
Okay, very interesting dynamic there. And yes, you're right on the chart. We're stuck in that range for the last few months. somebody's got to break it somehow, 3,800 to 4,100. So time will tell, but for the time being, it's come off the resistance line, and now just 4,050. So we will see how this shapes up over the next few days. There's a lot of things going on, but Russell 2000, this was an interesting chart you posted in the daily Fat Chat today. So what are your thoughts on the Russell?
Well, I think, this is an index that comprises 2,000 small mid-cap companies that make up the US economy and that are listed. And, I think this is quite a bearish setup. We've had numerous tests at the 1,700 level on the downside. The Russell 2000 has managed to hold up to date. But the way this looks to me is that we're headed for a downside break. In a similar way that we saw that the banking index broke to the downside. This has got a similar setup. So what does this all mean? Well, the US economy, clearly those interest rate hikes, that pace of tightening by the Fed, it's definitely tightening financial conditions. It's causing deceleration within the economy, and I think this chart pretty much says it all. Although if you look at the S&P 500, which is where 25% of the index is made up of those large, super large mega cap stocks, it presents quite a different picture. But this is a contrasting picture, and probably perhaps a deeper insight to what's really going on in the US economy, given that this index is comprised of 2,000 companies. So quite bearish, and again, it just underpins the rally that we've seen this year has really lacked breadth. It's being led by a handful of companies, and if we look at what's going on in the rest of corporate America, the picture is not quite is not positive at all. And I think this chart sort of says it all. Now's the time to be still stay defensive. That's the key message.
Yes, you're right, Angus. Agreed with that. And the other thing which is in the mix here as well is the US dollar. Look, it's bounced off the previous support, and it's just a tiny bit below 102 at the moment. How do you see that set up in the short term? Because that could have an impact as well, because we've got the Federal Reserve meeting coming up on the 3rd of May. If they raise rates by another 25 basis points, that could move the US dollar. What are your thoughts?
Look, I'm bearish on the US dollar. Roger, I think, yes, the Fed could raise by 25 basis points next week and leave interest rate settings at that and bring in a pause. I mean, that could happen. But I think the way the dollar has been trading, technically it looks to me like it's bearish. But we need to see a definitive break down below that sort of 101.50 level, 101. To really want to see the January and April lows taken out on the downside to sort of confirm that. And I think there's a number of drivers going on behind the scenes that could bring about that dollar weakness. The fact that the ECB, the European Central Bank, the Bank of England, and probably even the Bank of Japan are all going to have to put in further tightening and further interest rate hikes, given that inflation is still a problem in those countries. We'll see those interest rate differentials narrow with the US. So I think that's one structural driver near term that's going to put the US dollar down. Now, I'm going to write more about the US dollar tomorrow. So, listeners on the webinar today should stay tuned for that. It's quite interesting because there was a fascinating article about Stanley Druckenmiller in the Financial Times today, or I think it was yesterday. Stanley's largest short position was in the US. Largest position was a short position on the US dollar. So I'll be writing about that tomorrow. So that's interesting. And just keep in mind, what's negative for the greenback is potentially quite explosive and bullish for the precious metals, which tend to do very well, when the greenback is falling.
Yes.
So I'll be covering that in greater detail tomorrow.
Okay, great. So if the US dollar continues to go down, gold and precious metals go up. So that's the play for investors if you haven't done so already. But also a quick look at the euro, and that's now at $1.10 versus the US dollar. Your thoughts?
Well, I think the euro is about to break out on the upside. And that of course comprises sort of, almost 60% of the dollar index basket. It's a similar pattern to the pound. And, if we look at the near-term drivers, you'd have to say it's narrowing interest rate differentials with the US that are going to do it. As the Fed gets closer to a pause, you've got the other central banks still hiking. That interest rate gap, which has favored the US dollar, is narrowing and making the US dollar less attractive. So that's one driver. As I mentioned in today's daily, another driver is, the world seems to want to be moving away from trading in US dollars. I think this de-dollarization is a real trend that's underway, and albeit, it'll take several years for it to play out. More and more countries are seeking to do and denominate their trade with one another in currencies other than the dollar. And I think, this has got significant bearish connotations for the greenback over the medium to longer term.
Sure. Well, on that note, there's a question I might ask now. It's sort of relevant now. George asked a question earlier. He said, regular talk is of Fed looking at central bank digital currency called Project Hamilton. Is this a good thing or a bad thing, or is this really happening?
I think digital currencies, are here to stay. And, I am a believer in Bitcoin, et cetera, over the medium to longer term, because I think it does keep governments honest in terms of, anchoring them with respect to printing money. And, but yeah, I mean, whether a central bank takes its current currency digital doesn't necessarily take the propensity of a government or even a central bank to print money in times of need or, times of stress. I don't think that dynamic goes away. And so, as Stanley Druckenmiller said in his interview yesterday, and I couldn't have summed this up better myself, at some point the Fed's going to flinch. They're going to create stress within the economy, within the financial system, and they'll flinch and they'll back away from containing inflation, and that could be detrimental for the dollar. So as long as governments and central banks control the money supply, I don't think digitization is going to make much of a difference. Of course, cryptocurrencies that exist outside governments that are geographically borderless are going to be around for a long time.
Yes. Okay. Thank you, Angus. Just before we look at a couple of economic indicators, we'll also touch on oil now. Interesting here, Angus, because only a few weeks ago when OPEC really cut production, we saw oil really jump over $83, $84 a barrel. It's now come straight down to 74 over the last 2 weeks. How do you see oil at the moment?
Well, this is one slide that I sort of told everyone to keep an eye on when I went away on my publishing break. And of course, oil, had that move to the top side, and my concern a few weeks ago was if it did break out above sort of $83, $84 and ran away to the top side, that, that would see a reassertion of the inflationary impulse that, triggered the inflation that we're sort of battling today, a year or so ago. What we have seen is quite a sharp retracement. And, it could be one of a number of things. It could be the world is heading towards recession and a slowdown. I think that's a very real argument. Secondly, if you look at the behavior of the Chinese stock market in recent weeks, it hasn't been great. The CSI 300's slipped back to 3,900, 3,950. So maybe the reopening that everyone was excited about in China is not exactly playing out as well as it should be. And demand for oil in China is not really coming through the way that markets probably were hoping for a few months ago. I guess the other point to make about it is, it was interesting that President Xi was on the phone to Zelensky in Ukraine, and it seems to me like, and this was our base case, Roger, that the Ukraine war would get resolved this year. And of course, part of any settlement, Russia, for Russia to back off, and if there was to be some sort of resolution on that war, Russia would want to be reinstated into global markets and be able to access those higher crude prices. So, maybe it's got something to do with that. But, it is a warning sign. The oil price at 74, the fact that it failed to clear $84 and sustain that breakout, we need to see an upward dynamic. For now, we seem to be stuck in a range, so we'll continue to watch the oil markets closely.
Okay. Thanks, Angus. Well, at least it's one good news. A bit of a catch-22, isn't it? Because if it goes higher, then it adds to inflation. But now that it's consolidating, that's probably a sign of things to come. All right, we'll move on to a couple of indicators pointing towards what we anticipate is coming. And this one here is leading economic indicators and real GDP on the same chart. So the real GDP is the one in the red, and the one in the blue is the leading economic indicators. And usually when the leading economic indicators are pointing towards this negative correction, which you've seen plenty of times in the last 100 years, it is followed by a recession. It is pretty much 100% accurate. And you can also see the GDP every time it falls below the negative, falls below zero, then that has also been followed by a recession. So currently this is at the end of March, and you can see it's still on its way down. It hasn't consolidated yet, and that usually happens once the economy enters a recession. So that's one thing to keep an eye on. And the other thing is the GDP numbers, which are coming out tomorrow in the US. You can see over the last 12 months what we have seen. Yes, the GDP in the last 2 quarters has come down slowly. The expectation now is it to come around between 2 and 2.3%. So we will see what comes out tomorrow. But the other thing to note and keep an eye on is the initial jobless claims, which is a weekly figure. That's now been rising, as you can see in the last 12 months chart. And that usually happens, again, as a precursor to a bigger slowdown in the economy, followed by a recession. That also is coming out tomorrow. The expectation is 248,000 jobless claims, and that will keep that bar going higher. And this final chart here also shows the initial jobless claims over, again, a very long period of time. So just keep that in mind. And every time we're coming off historic lows, that usually, and they start to rise, usually followed by recession. Again, you can see many times in leading up to 2008, historic lows and jobless claims starting to rise. 2000, similar thing, historic lows followed by a rise and then a recession, and so on. So currently we're seeing a rise in initial jobless claims. Again, very early stage, but if that continues, that again could be something to keep an eye on. And the final thing is the money market funds. And we've talked about this in the last 2 webinars, is money moving out of the big banks, out of the regional banks, and because their deposit rates are very, very low interest, but now moving into money market funds where you can easily earn 4.5 to 5% in the US and closer to that 4.5% in Australia. And that again is rising and rising, and that usually happens during or early signs of recession, and only declines when the market have bottomed out. So that is still on the rise, and money is moving out of those low deposit rates. Finally, before we move on to gold and then property, Angus, ASX 200, we are at just a shy of 7,300 points. And just pointing out a few key technical indicators here on the chart. Every time we've seen short-term market tops, and we've seen the MACD right below really turn into the red zone or a bit of a crossover. Every time the MACD is crossed over, we've seen market tops in the short term, and we're just about to see the MACD now turning back into a negative zone. Could this mark a short-term top? Well, time will tell, but we're pretty close to it at the moment. So how do you see the ASX 200?
Still defensive, Roger. We're still carrying lots of cash, and we're heading into May, a seasonally weak period. I think it's been, it's taken some time for this earnings recession story to play out, but I think it's now beginning to come through, and that we're seeing that in the earnings season. It has been patchy. I think the interest rate tightening that the central banks have been putting through for just over a year now, I think they're finally beginning to impact the economy and slow demand. And, it's hard not to see how that's not going to impact corporate profit margins and indeed just profits. So I'm just remaining cautious. I think there's downside risk in the ASX 200 from these levels. And aside from the gold sector, I'd be sitting on the sidelines.
Yeah, I think that makes a lot of sense. And yeah, look, if history is to look at it, short-term volatility is probably ahead. But finally, gold price. Now, this is a bright spot. Australian dollar gold price is over $3,000. Even our Australian gold stocks, including Northern Star and Gold Road Resources and the likes, they are enjoying a good run. And I'm sure the members who've bought them at a good prices, they're probably feeling reasonably happy about them. So how do you see the gold price, and especially for our Australian gold producers?
Look, I'm bullish on gold. I think this is a very telling chart of the Australian dollar gold price. And like many other gold and many other currencies, we've seen new historic record highs. We've had a convincing breakout in spot Aussie gold above that 2,800 an ounce, and that prior to that breakout, we saw a lengthy 3-year period of base building, a series of higher reactionary lows, which is always encouraging, and of course the breakout earlier this year. I suppose the good news is that the gold stocks have moved. Most of them are still well down from their highs, despite the Aussie dollar gold price being in new record territory. So I think the gold sector is one sector that I think will do really well this year, particularly if we're right in our call on the US dollar weakening.
Yeah, that's something to certainly be excited about, and I'm sure members are feeling the same, and we are in the same boat here at Bat Profits as well. Let's move on to Simon. Simon, welcome to the webinar. It's been a while we've had you, so we were quite excited to have you today. How are you?
Yes, good. Thank you very much, Roger.
Excellent. So over to you. We're going to get some good updates from you today about the property sector, the REITs. So passing over to you now.
Yes, look, I guess the REITs and real estate sector, they have been an interesting space. They've been down considerably since the beginning of 2022, which was really the peak of the sector. You can see here on this chart, which is the US MSCI REIT index. That's still 28% off its peak of where it was at the beginning of 2022. I guess what we have been seeing, a number of investors and analysts at the beginning of the year were overweight property. Since then, the sector has been really trading sideways, both domestically as well as globally, and there's probably been a bit of a negative bias towards where that pricing trend has gone over that time. I guess the way we look at it, there's a number of sectors which are trading at significant discounts to their NTA and NAV. So a lot of these REITs we're looking at are already pricing in the expectation of considerable downside risk to property. and we'll talk a little bit about residential in a minute, but as you see at the top of this slide, the fact that house prices are bottoming in Australia in particular at the moment, bottoming well above the level where analysts were forecasting them to bottom only 3, 4, 5 months ago, potentially could be something that has some correlation for the commercial REIT sector. So what's driving the discounts and the weakness? Really rising rates and disruption to space use. So the fact that there's an increased work from home element impacting on the office space in particular, that's probably the most topical component at the moment. And there's also been quite a bit of discussion around retail spending. Retail spending had been strong. However, there was an expectation that discretionary spending would get hit with the rises in interest rates. And as we've seen from recent retail spending data, that hasn't been the case. It's been surprisingly resilient. And as a result of that, the shopping centre REITs have been more positive. They've been deeply discounted basically since COVID, but have bounced back and have been a bit more resilient and starting to be viewed a bit more positively than other sectors. Obviously, the other thing is the cost of debt funding. That's a key driver of pricing and demand. Investors are commonly looking at the cost of debt versus the return that they get on their real estate, the property. One thing we have seen is that the monthly cost of debt and servicing that debt has increased substantially over the past 12, 14 months. In a number of cases, if you've got floating rate debt, that cost of debt, your monthly cost of debt has tripled. So it's quite substantial. And what that means is that from an asset value perspective, either asset values need to adjust down so that investors get the same rate of return, or investors accept that lower rate of return, which is a counterintuitive outcome in our view, where the risk-free rate has been rising. In terms of asset values, to date, there's been minimal evidence of meaningful asset value declines, and high inflation's helped soften the impacts. But there's a couple of asset sales that are coming up at the moment in the office sector, and the market's watching those quite closely. Just on the next slide, you'll see that if we look across various global sectors, America's actually had a reasonable quarter despite that past chart. So even with that, it's still down nearly 30%. Asia has been, and Australia have been relatively flat, just on small declines, basically bouncing within a bit of a range trade. And then if we look at Europe, that's had quite a bit of volatility over the last quarter, and particularly during March. There was a big sell-off in a lot of sectors there as investors became more bearish around particularly the office sector and space demand and usage in that sector going forward. For our Fat Profits Global Property Fund, the FPP, there's a similar discount to NTA that the current share price is trading at. It's trading at around an 18% discount right now. One of the things we would say, though, is that that's essentially a double discount, because FPP invests in listed REITs globally. Those listed REITs are already trading at substantial discounts, and with FPP trading at a discount to its own asset value, it's essentially doubling up the discount there. So historically, the fund has been trading at a single-digit discount to NTA, and I think potentially as things stabilise a little in the value sector, and we get a good read on where asset value NTAs are, then we would hope that discount narrows more in line with the current NTA, which is 82 cents per unit. Just on the next slide, we look a little bit at office space. The market has, I guess, probably focused or is focusing more on office space at the moment than other sectors. It's been fearing large declines in asset values, and this has been driven by changing work habits. Obviously, the main one of those is work from home thematic, which is causing office tenants to need less supply overall. So whereas there was typically everyone used to go to the office all the time, now you're getting a portion of the office going in during a portion of the week, and that's meaning that tenants now need lower space requirements to meet the demand of the employees. At the same time, in Australia in particular, there's still new supply coming on, and the result of that is higher vacancy and a risk to rents as I guess vacancy rate increases and demand softens. The obvious outcome there is that we're going to have some weakness in office rents, and that'll flow through to office values. So there has been expectations that office values could fall by as much as 20 or 30%. There's a couple of larger office properties on the market at the moment, which are being sold by Dexus as they're lightening off some of their exposure, and the market's pretty keenly waiting to see what that is looking like. I think initial views are that that'll be down around 15% versus their peak asset values. And if we look at where we're sitting in terms of FPP, we actually sold the majority of our holding in Dexus. It was one of our larger holdings because of its funds management exposure last year, but we sold off the majority of that earlier this year as we started to become more concerned around where the value in the sector is looking. Just on the next slide, we'll look at where various subsectors are looking. As we've talked through most of the office space there. Industrial has been the opposite. Industrial has been the sleepy sector for many years, with rents rising at around CPI 2 or 3% per annum. At the moment, we're seeing that is very substantial. It's increasing. Rents in many cases are increasing 40–60%. So there's significant under-renting occurring in many markets, and there's close to zero vacancy in many markets as well. So it's good times for the likes of Goodman Group in Australia and Prologis in the US, which is the largest industrial REIT in the world. And those REITs have both been showing good underlying EPS growth and getting some reasonable valuation support from investors. Shopping centres, we kind of break into two components. One is the discretionary side, the larger Westfield shopping centres. They're still trading at fairly hefty discounts to NTA, but have been more stable as investors start to realise that that customer visitation's back above pre-COVID levels, and retail spending's been quite solid. And convenience retailing, or essential retailing as it's called in some sectors, still has quite positive fundamentals, and the fact that CPI has been high has also been driving underlying turnover, which ultimately drives underlying rent and value for that sector as well. So that one's still in quite good demand globally. The bottom three are a little bit more niche. Self-storage as a sector we're invested in and we quite like. There had been good growth rates out of that through COVID, and we're starting to see some of the rent growth there cycling back to an occupancy rate cycling back to flat levels at the moment. But we still expect to see some M&A in that sector as consolidation continues to occur and the big players continue to expand their global footprint. And then on data center and healthcare. Healthcare is actually a very big sector, particularly in the US. It's been performing with very mixed results, even though it's a core fundamental sector, and investors are still looking at the underlying driver demands there, which can change materially depending on whether you're a hospital or whether you're acute care or whether you're essentially retired living space. So that's a sector which has its opportunities, but you need to be very selective within it. And data centers, again, quite big in the US. We don't really have much ability to get invested in that sector in Australia, but I guess one of the broad themes that's been happening in real estate has been moving away from old school real estate, which is your office style real estate, into technology driven real estate, which is really data centers and industrial as well, because industrial demand has been driven by internet retailing, etc. So just finally, actually we don't have the chart on there for residential, but yeah, I was just going to comment quickly that residential has been very strong. oh, sorry, not very strong. I should say it's very much exceeded expectations. So expectations, you will have, or many on the call will be aware that there'd been significant declines forecast in house prices. The peak to trough house price move has not been anywhere near as deep as expected. It's around 8 or 9%, and you can see in the chart on the left-hand side there that ANZ's moved its house price movement forecasts in 2023. It was previously forecasting just late last year that we would have close to 10% declines across most markets. Now that was in 2023, and now they're forecasting that it's essentially going to be flat for the main markets of Sydney, Melbourne, and Brisbane, just +2 -2% variance. So we have looked at that and said, well, is there something similar as a potential for the drivers of commercial property? Is commercial oversold? We think there is some risk that is the case, but ultimately it's been the fact that for residential, very low levels of supply have been a key driver, and strong or high immigration and very, very high increases in rent growth as well, have all kind of contributed to the market hitting a floor much sooner than expected.
Okay. Thanks, Simon. We'll take a few questions now popped up from members. First question is regarding FPP, Fat Profits Property Fund. So this came from Dennis earlier, saying, what's happening with the general non-residential property sector, and in particular, why has FPP lost about 30% in the last year versus, say, for example, vicinity sectors, VCX, which is up around 10%?
Yeah, I think, as I say, firstly, the share price for FPP is down a little bit more than its NTA. The NTA for the fund is down around 20%. You can also see, as we're discussing, that most sectors, including the Australian REIT sector and the US REIT sector, are down in the order of 30% over the last 12, 18 months as well. So essentially we're broadly going where the market's been going. There are obviously some specific stocks like Vicinity, which we did hold for a period of time, which have had more positive outcomes recently. They were one of the more heavily discounted REITs relative to their underlying NTA, and have benefited from that retail spending being more robust in Australia than had been forecast.
Okay. The next question is from Gary. So he's saying, what is expected with office REITs regarding the work from home situation?
Yes, I think that's the work from home is, I guess the real question here is it going to be a temporary phenomenon, or is it embedded longer term? And I think that our view is that it's a longer term embedment. There's been a material change in the way people work, and how workforces can be more regionalised through the COVID period, and that's been sustained globally, as well as in Australia. So that will have clear impacts on the way office tenants think about how much space they require, and ultimately I think that it'll mean that they have incorporate more I guess hot desking within their offices, where people can come and go, and that they don't have dedicated desks, and they can downsize their space requirement, in some cases by 40 or 50%.
Okay, very good. The next question is from Mark regarding the fixed interest rate. So his question is saying, what about fixed interest bomb in the second half of 2023? So I guess what he's referring to is a lot of fixed home loans coming off and going into variable. So how will that impact the property sector? I guess that's his question.
Well, I guess there was a view that would be a material impact, and that's just around the corner. The fact that a number of forecasters like ANZ have materially changed where they expect the sector to bottom out suggests that they don't think that is going to be as much of an impact as they previously did. I think that the downside to house prices that was previously forecast, a large part of that was this refinancing cliff that was coming up being factored in. But bad debts are relatively low. There's very surprisingly high demand for for residential property, which has been continued all the way through these rate rises. Has, I think, surprised a number of observers, and the depth of capital that's out there, combined with the fact that immigration is still very strong. We're still expecting 650,000 new immigrants, well above normal intake rate over the next 2 years. So that puts pressure on rents, which puts pressure on house prices. And obviously, one other thing is people often look at the comparison between the cost to rent to cost to buy. Obviously, interest rates are going up, and the cost of servicing mortgage and debt is going up. But there's been very material increases in the cost of renting as well. So that has helped soften the blow for house prices.
Yeah. Okay, great. Thanks, Simon. Angus, a couple of quick questions for you before we round it off. First one, just come about the cryptocurrencies remark. So this is from Kev, saying Angus mentioned he's a believer in cryptocurrencies. Does he see a further correction in Bitcoin, and when would be a good time to buy?
Okay, so look, I think the cryptos are going to be fine over the medium to longer term. But as we've seen, when the VIX blows out, in various sell-offs that we've seen and drawdowns in the market over the last 12 to 18 months, the cryptos get caught up in that as well, and quite acutely so. So, precious metals probably not going to be immune either if we did see a serious drawdown in the market, but I'd expect the precious metals to hold up a bit better. So I'm still cautious on cryptos. I wouldn't be just rushing in there. My favored way of playing the weakness in the US dollar is via precious metals and precious metal equities, and I think that precious metal equities are still offering a fair bit of value, given that many of these producers are generating, significant amounts of free cash flow at spot prices, and yet their share prices are well down from their record highs. So I hope that sort of answers the question. Yeah.
Okay, thank you, Angus. And the last question regarding FPC, the Contrarian Fund. So this is from Manfred, saying, what is the plan regarding the losses in FPC? So how do we see that at the moment?
Look, I can't really comment on that, Roger. That's something that really needs to go out via the ASX, via the board. So I can't really talk about that on this webinar.
Okay, makes sense. So yeah, that's something which, because it's a listed fund, we've got to follow the process. But look, on that note, I think we've got plenty of questions still coming through about property as well. So look, if you do have any further questions, you can email members@fatprofits.com.au, and we'll be happy to come back, or you can call us on the 1300 number. But all in all, look, it's been an interesting week in the markets. There's a lot of information to come through in the coming days with earnings season, Federal Reserve rate hike, and of course the jobless claims, GDP numbers. So stay tuned, keep an eye on the emails, and as we've said earlier, stay defensive. That is the message. Keep good levels of cash, and the opportunities to buy are coming, and we'll be waiting for those. So on that note, it's a goodbye from my side. I'll pass it on to you, Angus, for your final words.
Yeah, thanks, Rog, and I look forward to joining you same time next Thursday. Bye for now.
Excellent. And Simon, your final words? Okay, looks like it's gone. Okay, bye for now.
Thank you.